Hello and welcome to another video. In this one, we're going to talk about installment notes payable. In this exercise, on January 1st, 2024, Mitchell Company purchases new equipment for $700,000. We are required to make a down payment of $100,000 and issue an installment note payable for the balance. This note requires payments of $81,905.88 every 3 months, beginning on March 31st, 2024. Over the next 2 years, we're going to do this. So we're going to make a total of 8 payments, 4 in the current year, 4 in the next year. The interest rate on the note is 8% per annum or 2% every 3 months. So it's basically 8 divided by 4 because I'm making 4 payments. That's 2% every 3 months. We've been asked to do the journal entry on the date we purchase the equipment and the first interest payment date, the note payable date. So we will do 2 installment notes. We'll do 2 installments. We'll do the journal entries for 2 installments. So let's first get started with acquiring the asset before we get to make any payments. So to start with, in my journal, I'm going to have my journal and I'm going to have a T account for notes payable to keep that interest calculations a little more manageable. So we start with on January 1st, 2024, I acquired an equipment. That part is easy, equipment debit. I know the amount, that's $700,000. I parted with cash, I paid cash, so cash is credit, and that's $100,000. The remaining $600,000, I'm going to make 4 payments, 4 payments each year for 2 years, so a total of 8 payments. And that's my notes payable. This is the installment notes payable. So now let me have the notes payable account. I'm just posting this notes payable number. That's $600,000. On March 31st, I'm going to make my first payment. I know the amount I'm going to pay. So I'll write cash credit. I know exactly how much I have to pay. It's given in the problem. It's $81,905.88. Cash credit. This installment that I'm making, a part of it is interest, and then the rest of it is paying off the note. So this full amount is not for the note. It includes the interest payment. Interest is always calculated on the outstanding liability, on the outstanding notes payable. Outstanding means how much I still owe. So this 600,000, let me bring that down here, carry that number down. 600,000 times 2% is my interest expense. So that's $12,000. So of this amount that I paid today, my first payment, $12,000 of that is interest. So the balance was towards the liability, the notes payable. So that number works out to $69,905.88. It's just a balancing figure over here. Notes payable is debit. Let me plug that number in over here. It's posting the number. I post the number and I come up with my ending balance. Now, the next time I make a payment, that's my beginning balance over here. That's the balance, the outstanding loan that I have. So let's go ahead and do one more interest calculation. So I'll have one more payment. Now the journal entry, the debits and credits look exactly the same. The cash credit, that's exactly the same. I'm going to make 8 times. I'm going to make this payment. Now I have to recalculate the interest expense. The reason I need to recalculate is my note payable balance has changed. It has decreased. So this number multiplied by 2% is a new interest expense. And that is $10,601.88. What you will notice over here is, let's look at these 2 interest numbers. The 2 interest numbers have changed. From 12, it dropped to $10,601.88. That's because the outstanding balance changed. It decreased. Therefore, the interest expense decreased. The balancing figure in the journal entry, this is the plug number. That's 71,304. Now, again, what you will notice is the note payable that I repaid, that has increased now. Because the interest is smaller, the note payable is that I'm paying off is larger in the second installment. And that will keep happening throughout the life of the note. So my new balance now is $458,790.12. It keeps decreasing until eventually it becomes 0. After 8 payments, this notes payable should become 0. So this is an example of our installment notes payable. All your car loans, your home loan, they're all notes payable, installment notes payable, obviously for a much longer period of time. So remember, the key over here is interest expense is always calculated on the outstanding balance. So find out what the outstanding balance is, and then the rest of it becomes easy. Hope this helps you with your homework assignment.